Afternoon, guys. Welcome to what could be prep for a very important FOMC meeting coming up tomorrow, the September meeting. The whole market's been waiting for this potential meeting for a long time. It's the first one that's potentially live. So today, part one, we're going to do fundamental prep for it. Part two will be tomorrow, where we go as per normal through our trade plans. So to start with, as per normal, I'll go through the Fed mandate and the meeting format. Then Brannigan will go through what happened in the previous meeting along with the data since the previous meeting. I will then talk about the market pricing and expectations, and then look at some of the key focus points, which I will do and Brannigan will add to as well. So the Fed mandate, you should all be very familiar with this by now, to support continued progress towards maximum employment and price stability. Now that essentially is inflation, unemployment, and that's what the Fed's been looking at for quite some time. It used to be just employment, but now in the last year and a half or so, they've added the inflation mandate, so it is a dual mandate. So the format of the meeting, it's on a Thursday this time around, first time since I can ever remember actually. Could that be a sign that something may happen? Who knows? I know there's a few conspiracy theories out there, one from Mr. Brannigan himself, thinking the Thursday could signal the start of the hiking cycle from the Fed, but we'll see. Anyway, Thursday is when everything gets announced. They're actually meeting from today, and it will continue into tomorrow. Thursday, 7 p.m., we will get the announcement of any change in the Fed funds rate, updated dot plot, updated economic projections, statement release, and also it says here announcement of any QE or tapering, but to be honest, that's not going to happen today or tomorrow rather. So I mean, this meeting, as I said, is important because it's the first time in a long time where we're actually looking at the announcement of any change in Fed funds rate. So essentially split into two parts, 7 o'clock that, 7:30 we then have Q&A and press conference and Q&A with Yellen. That could be very insightful, especially if they do nothing. That will probably be more insightful. But see it as two different trading events and opportunities, I suppose. And I will come back later to talk through market pricing and some of the key focus points. But for now, I'll hand over to Mr. Brannigan Barrett.
How's it, guys? Do you like my mic, huh? Okay, first things first, if you can just shut off those lights. We're going to go through the previous Fed statement. Okay, make sure we're up to date with what the Fed had signaled as of the July meeting. So, to note, I'm not going to go through the Fed statement. You've got that there. You can always go back to the video, take a snapshot. But that was the release. That's what it's going to look like on your Reuters tomorrow night. Okay, so you need to first thing to make sure your eyes are pointed out at the key thing. Now, obviously tomorrow the first thing will be in terms of the rate. When they talk about rates, if they keep them on hold, or this Fed leaves key policy rate unchanged. That's where your eyes need to go directly first thing tomorrow. Okay, if they change rates, we will highlight that nicely for you so you can see if there's a change. If not, the next best thing, as Imran will talk about probably a little bit later on, is the dot plot. Okay, that's probably the next most important thing in tomorrow in terms of the statement release. In terms of a summary, okay, the highlight from the previous statement, Fed will hike with some further improvement. Okay, this used to be Fed will hike with further improvement in the labor market. They specifically added the word some in. You'll see when I go over the minutes, they specifically did do that on purpose. It was purposely done. They then spoke about, okay, it was a unanimous vote, as it has been for some time. Right? Bear in mind that I think 6 months ago or 5 months ago, back early on the year, it wasn't always a unanimous vote. The Doves were always sort of voting against the majority. We are now in a unanimous board, which is very, very good. Okay, it's good for the board to agree when they make decisions. So again, do we get a unanimous vote tomorrow or not, based on how they react? And then they repeat their inflation continues to run below objective. This is very important because this is something the Fed's been watching quite closely, and they're continuing this line of it's partly reflecting earlier declines in energy prices and prices of non-energy imports. So very important that they keep committing to this one-liner, because that means that effectively their medium-term inflation outlook is still the same, and that it's just transitory factors. And once those transitory factors start to abate or fall away a little bit, then we will start to see inflation steadily pick up. So that's what the June meeting statement July. That should say July. That's what the July statement was. Let's quickly have a look at the video. Now, what I want to point out, and just one thing to note, is that, and a mistake a lot of people make, and I'm going to show you something on the ladder now, is that they tend to think that super intelligent people read this stuff in about 5 seconds. Yes? Okay, go to about 2 minutes 30 for me, and then just push pause for me. Okay, just scroll, go down the page a little bit, yeah? Just come down the side, yeah? Yeah, just scroll down so I can see the ladder. Okay, make it 75. Just bear with us for 1 second, guys. Okay, go again, just scroll down a little bit for me. Okay, come back to 2 minutes. Okay, so this is roughly 30 seconds before the announcement. Now, what I want you to point out, and this is probably the most important thing why we're going to go through the ladder, right? This is effectively the US 5-year, and this is the US 10-year. Now, what do you notice on the ladder? It's absolutely thin. If someone were to buy 30 lots, all right, they're going to take out 7 or 8 prices. Okay. Now, more importantly, I want you to watch effectively once the statement comes out. Okay. There, the statement's out. Now, note the bids and offers. Push pause there quickly. Okay. Note the bids and offers now in the first. Push pause, top left. Okay. So note the bids and offers, guys. As you can see, there is absolutely nothing in the market. Okay. Now, a common mistake most traders make is that they tend to trade the Fed statement off the price action. Okay, I'm going to teach you something today. You do not want to trade off the price action, particularly tomorrow. Why? Because when the time comes that there is a significant decision that comes out, something that's really, really big, okay, you could, for instance, in this case, the market initially went down, or sorry, you'll see in this case, the markets initially went up, okay, but only after about 30-40 seconds did they pick up the change in some gains. Okay, it took a minute or so for people actually to realize that it was a relatively hawkish type statement. Okay, so if you're going to trade off a ladder, you're going to shoot yourself in the foot. Take your time. That's the point of this. You've got 30 seconds to ignore the price and read the Reuters. Read what's being said. You do that and a golden opportunity comes, you will have sufficient time not only to enter the market, but you will then also be trading when everyone else or size or institutions start trading. Do you understand me, guys? Don't shoot yourself in the foot by being too quick, because I promise you, no one is that quick. No one intelligent that's non-machine is that quick. Okay, and you can clearly see it with the bids and offers. So let's play this on, and let's see how this plays out for the first minute or so. So we're just going to play this and let it go through. Okay, bear in mind, there was nothing new relative in the statement. The only change was the sum gains. Now note the bond markets, guys. Bond markets aggressively going up. Okay, maybe pricing out any kind of a potential of a hike, potentially. Maybe there was positions going short into the market. Okay, but effectively, you can see the market is very, very, very thin. Right? At this point, yeah, you can see a little bit of absorption coming into the market. You can see a little bit of size with an 800 lot coming into the market. Okay, so if you're not going to trade the statement and you just want to trade pure price action, look for the size. Okay, get in front of the size. All right, now if Imran, if you can scroll this to 4 minutes for me. Okay, so if you note for 4 minutes now, and again, I'm using the 5 here just because it's a little bit more interest rate sensitive. If you scroll to 5 minutes now, okay, and if you scroll to 6 minutes, okay, so it took the market almost 3 minutes and 30 seconds to pick up on the sum gains. And ultimately, if you scroll on towards 7 minutes, okay, you'll see the markets all the way back at the starting price. If you go to 8 minutes, you'll see it back at the low. Okay. Do you see there, guys? You don't have to be the fastest finger. What you do need to do is interpret the statement. And that's why we do the fundamental preparation. You do that, you take your time, you enter slowly, and you will get a golden opportunity as we got here. Okay. Note, guys, the last thing I want to point out. The difficulty, and this is something that requires a lot of confidence. If you read something that you feel is very hawkish, very dovish, you sometimes have to just be stubborn and sit on your hands. Okay, don't be afraid to go off sides if you've read something that you've prepared for that is significantly hawkish or dovish. Okay, be a man, suck it up, and just go off sides a little bit if you need to. Okay, wait for it. As you can see, the market will eventually correct itself. Okay, that's the ladder. Let's then turn our attention and have a quick look and just run over the dot plot. Now, so important, this is the latest dot plot. Remember, guys, this is the first dot plot we're going to get since the June meeting. That's 3 months. Now, it's 3 months ago, the Fed came out with a very dovish dot plot. They downgraded their 2015 forecast to reflect potential 2 rate hikes for this year Okay, it's being expected that they're probably going to downgrade that to 1 rate hike for this year. Okay, or 1 and a little bit. Now, the important thing to note from this dot plot is the consensus. All right. Now, remember, the entire 2015, the board has told us they're going to hike in 2015. We've only got 2 more meetings after tomorrow, so 3 meetings in total. So at some point they're going to hike, which means the following, guys. Right? If they do not hike tomorrow, there is a very high probability they're going to signal a hike tomorrow. Okay, you need to factor that into your trade plans, because if they don't hike, you might get an initial dovish move, but then you might get the hawkish rhetoric signaling to the market that actually we're going to hike. And that's going to create knee-jerk type patterns in whatever market you're going to trade. So make sure you factor that into your trade plans. Okay, but that consensus view is very, very important. Now, quickly, I'm just going to go, this is now the July minutes. So again, guys, it's all good and well just reading the statement, but you have to read the minutes, because the minutes reflect the opinions of individual members. You get a feeling for how the board is voting. Now, again, if you scroll down again, you guys can take a snapshot and read that, but the highlights from that, okay? Fed officials agreed to alter the statement on when ready to hike rates by saying some further improvement. In other words, they came to an agreement that they needed to be a little bit more direct in their signaling, and they used the word some further improvement to signal intent. In other words, if they were to see some further improvement in the labor market, that would be them effectively looking to start hiking rates. Okay, they purposely mentioned that. Now, it's important to look at that statement, because what we're going to do in a minute is we're actually going to look at the labor data. We're going to see, has there been this some further improvement? Then, they said we needed more evidence of economic growth, and that the labor market is strong enough to lift inflation. Now, this is an important line, because effectively what they're saying is the labor market right now is good. Okay, even with the slowdown globally, the labor market is strong enough to start creating inflation via wage growth. Right? But they're saying that we wanted to see a little bit more evidence of economic growth. So, the retail sales, the PMI numbers, okay, etc., etc. Then, many Fed officials thought labor market slack eliminated in the near term. Okay, again, note, Yellen at the start of this year, or even since the start of her tenure, came up with the idea of slack. She was one of the first central bankers to talk about this idea of slack, and there being a lot more slack than anyone had thought. Okay, she hammered home this idea of slack. And what she wanted to point out was that so long as there is slack, we will not see wage growth. And so long as there's no wage growth, we will not see inflationary pressures start to build. So important to understand, because now all of a sudden that slack is being eliminated. And we are starting to see signs of wage growth, of employment costs starting to rise. And that will lead to inflation. And then rate hike is still not warranted, but we're approaching that point. Now, the reason I want to include that specifically is because there's a lot of people out there that are saying that the Fed's effectively is not communicating, not signaling to the market. But in actual fact, the Fed is. Okay, they're saying a hike is not warranted right now, but the time's coming. So they are preparing the market. It's just they're not being as direct as the market would like them to be. And then phasing out of reinvestments. Okay, so effectively as their bonds mature, they reinvest those at the moment. There was no decision taken yet, but keep that in mind, because that will be a very, very hawkish signal when they actually come up with an idea, or when they do start tapering out their reinvestments. Okay, that'll be a sign that we're ready to start seeing higher rates in the US. And then, just in terms of market reaction, okay, it was initially taken as hawkish, but then we saw a very, very aggressive unwind. So the bonds sold off initially, before not just reversing, but then having a very aggressive trend move in the opposite direction. Okay, so something in there, whether it was a positional squeeze, but something in there the market had taken as a little bit too dovish from the minutes. Okay, that's effectively the previous meeting. Now, let's turn our attention to the data and have a look at what the Fed's going to look at. So the first thing is the NFP data. All I want to say is September's number, lower than expected on the headline. However, remember, it is traditionally or seasonally known that the September numbers are lower than expected, and they do tend to get revised up. Right? So the market consensus was that whilst that was lower than the headline, it was actually a very good number. In terms of the prior, so in terms of August, okay, we had 215 versus the 222 expected, so as expected. In terms of unemployment, note, we went from 5.3 in July to 5.2 in August to 5.1 as of September. Okay, and then obviously earnings growth has gone from 0.2 in July to 0.2 in August, and now 0.3 in September. So as you can see overall, the labor picture looks relatively good. Okay, there are some gains, it seems, in the labor picture. Now, just to note, the purple line is our average. Okay, so that's the average for the last 12 months. We can see 240,000 jobs being created every month. Note, we had the slowdown at the beginning of the year. Why? Because there was lots of snow and lots of weather-related issues. But we've since seen that pullback. And now the question is, the Fed's asking is this a small pullback before an acceleration? Or what's going on here? Okay, so right now the labor picture looks very steady, as it has been for some time. Okay, let's then have a look quickly. I'm going to skip over the manufacturing data. The important thing to understand about the manufacturing data is we initially saw a little bit of a sort of an aggressive move 2 months ago, sort of June, July, and since then we've seen a little bit of a slowdown or a pullback in the PMI data. Okay, so the manufacturing sector is being affected a little bit by the stronger dollar, okay, and by the export environment we're in with a slowdown across the world. So manufacturing data is a little bit weaker at the moment, and the Fed will pay attention to that. In terms of the CPIs, okay, we got this out today. As you can see, today's release was a 1.8 versus an expected 1.9 year on year. Okay, as you'll see when we pull up the chart, okay, it's not altogether a bad number. Why? Because, well, we've been stuck in this range of 1.6 to 2% for almost 2 full years. All right, so the important thing for the Fed when they look at this is they want to make sure that that is now the trough and that the next stop is back towards the 2%. Okay, but as you can see, inflation for the last 5 months is contained. It's not going lower. Okay, that's the important thing to understand about inflation. It's very, very steady. Okay, so that's the core CPI. And then let's have a quick look at the core PC. Okay, so personal consumption expenditure. Again, note, it's been flat 3 months in a row. Right, consumption expenditure is flat. Why? Because, well, wage growth is relatively flat right now. So as you can see, we've had a little bit of a pullback over the last couple of months, but mostly we've sat on this 1.2 for 3 months in a row. Okay, very, very flat number, not really going anywhere just yet. And then our core retail sales, again, we received this number yesterday. Okay, it was mostly in line yesterday. You can see, sorry, that's meant to be negative 0.4, right? You can see we've gone from a negative number back in July, back in August, to a positive number in September. Again, note, very, very confined retail sales, okay, but well off our negative prints that we had late last year and early this year. Okay, that's the retail sales. Okay, then our inflation expectations, something that's been spoken about quite a bit. Now, 2 things I want to point out about this. We've seen a slow little grind in the tips market. Now, if we get the 5-year tips up, you'll see what I'm talking about. Now, what I want to do is I just want to annotate this chart in terms of how the year's gone. Now, this down move that we saw at the beginning of the year was when the whole world was talking about global recession and deflationary fears and the end of the world was coming. Okay, since then we troughed out and we've kind of just seen a little bit of aggressive sort of a move up once the ECB started QE and once we had the unwind in the European bonds. And since then we've actually sort of almost continued to see this slower drift higher in inflation expectations, which altogether is a positive thing for the Fed. Right? The reason that at the moment the Fed is a lot more hawkish than what the market is because the market doesn't believe the inflationary pressures. It doesn't see any signs of inflationary pressures. Right? So as this starts to correct higher and higher, we will then start to see the Fed become a little bit more, or they're then able to become a little bit more hawkish as the market and the Fed start to agree on the path of the US economy. So that's the inflation expectations. And then the last thing is let's have a quick look at oil and dollar. Remember, the Fed has spoken about them being transitory. In other words, stronger dollar and lower oil is affecting inflation in the near term. Now, it's important to understand, remember, we've seen this appreciation. So the Fed, rightfully so, said, the dollar has appreciated. It's expected because of the diverging policy stance, right? But since then, since the previous meeting, which is that point, right, the dollar is only down effectively 1 point. I think it says 3.2, yeah? Yeah, so 1.32% lower, right? So nothing really major. We're still very much in a very strong bull trend, but right now the dollar is a little bit weaker than where it was back in July. And then our oil price, okay, as you can see, we were somewhere around this little area back in July meeting time when the Fed met. We're now roughly $3 lower and pretty much 5, 6, somewhere there, depending on where oil closes, they're 5% lower. So not significant, okay? Nothing major. Obviously, oil is still a concern for the Fed, but no real major moves in the oil and dollar market since July. So yeah, that's the data, and I'll hand over to Imran.
Cool. Thank you. Click. All right, guys. So this meeting, as I said at the start, I cannot reiterate how important this meeting is. It's potentially the first time in 7 years that the Fed will hike rates. And this is really the very first live meeting that we're having in terms of an interest rate decision being the most watched thing. And you know, the market's been waiting for this for the last year and a half. They may hike tomorrow, they may not, but now this is why we're going to go through this, what the market is actually pricing. So the current Fed funds target rate is in a band between 0 and 0.25%. Currently the rate is at 14 basis points, so for 0.14%. So it's still it's been fairly stable, roughly speaking, in the middle of that band. Now the first rate hike by the Fed, from the Fed, is fully priced for January 2016. That doesn't mean there's nothing priced coming up for this meeting, October meeting, December meeting, but it's only fully priced for January 2016. Now, actually, that's not entirely true, because I'd say the market is pricing, say, a 90% of a chance that there is a full rate hike by the end of the year. But in terms of fully priced, it's January. So if we look at the current market pricing relative to the current Fed dots. Now the Fed dots, as I mentioned, will get updated, so they are a little bit out of date at the moment. But the current market is pricing for year end, this is via the Fed Fund futures, a rate of 33 basis points by year end. So essentially just under one rate hike, which is kind of what I mentioned a little bit earlier. The current Fed dots, 0.625%. Now that's expected to be reduced this time around to 0.375, so it's still lower than what's expected with the Fed dots. December 2016, end of year expected at 0.9% from the market via the Fed funds. Fed dots say 1.625%, so a lot lower. Again, Fed dots is expected to be revised lower, but even still the market is going to be underpricing based on pricing less than what the Fed dots imply. And December 2017 will show a similar story. Again, this is expected to go down, but the market currently pricing 1.48%. Fed funds rate at the end of 2017, significantly lower, irrespective of what they decrease the dots by. I think it's expected to be lowered by about 0.5 percentage point. So the Fed meets 8 times a year. Dot plot suggests that the Fed may raise rates twice in 2015. Obviously, if it goes down, it will be once. Whereas the market is indicating one. The market is indicating from there about 2 rate hikes in 2016. If we go 0.33 to 0.9%, 2 25 basis point rate hikes. And then 2017, it's about another 2 to 3 rate hikes, assuming they go in 25 basis point increments. But to be honest, the focus really for this meeting is this. Current Fed funds rate is 14 basis points. Year-end market pricing is 0.33%. For that to happen, it's the best part of a rate hike. Now, when will this rate hike come? Is it today? Is it going to be in October? Is it going to be in December? That's what the market will really be focusing on. For this particular meeting, the market is pricing about a 30% chance of a rate hike. So it's a strong probability, it's a strong possibility rather. But what I want to get across to you, whatever happens, you shouldn't be surprised. If they hike rates, sure, the market is only pricing 0.33%, a 30% chance of a rate hike, but the Fed have been talking about this for a long time. So it really is important that you're not surprised if they hike rates. By the same token, if they don't hike rates, you're not surprised either, because the market's not really expecting it. Kind of a 1 in 3 chance maybe the STIR markets are placing on that. Okay, if we can go down. So that's what the market's pricing, but the key things to watch out for. Typically I have 4 from here downwards, but today, or tomorrow rather, the Fed funds rate announcement is the key thing In previous meetings, we've talked about dots, we've talked about statements, outlooks, forward guidance, global outlook, inflation forecast, but this is, for the very first time in a very long time, the key thing we're looking out for. So Fed funds rate announcement, followed by the dots, outlook, language, global outlook. Okay, so the Fed funds rate announcement. Fed for the last 6 months or so have been saying it is appropriate to raise the target range for the federal funds rate when it has seen some further improvement in the labour market and is reasonably confident that inflation will move back to its 2% objective over the medium term. In essence, that should be all the Fed are focused with and concerned about in terms of will they raise rates at this meeting, will they not? So the possibilities are for a 25 basis point rate hike. Now, the Fed will do this if they believe that these conditions have been met. They're reasonably confident that inflation will move back to its 2% target and that they've seen further improvement in the labour market. Now, we know categorically, fact, this has been met. So basically, it comes down to this reasonable confidence in inflation reaching 2%. So unchanged rates, that's another possibility. That will happen essentially if they're not reasonably confident that inflation has, over the medium term, will reach that 2%. Why? Well, there are a few factors. Oil prices, China slowdown, emerging markets, maybe not quite the wage growth they want at this moment in time. But essentially, it's going to be inflation that prevents them through whatever mechanisms from not hiking rates. Now, on the 25-point rate hike, analysts are split 50-50 on whether this will come. So half the analysts are calling for a 25-point hike, half aren't. But remember, the market and the analysts, there are a little bit of disconnect because the market is not placing a 50-50 probability on this. The market is placing maybe a 30% chance that it will happen this time around, as it says here. And there is also a minority view, which is for something in the middle, a 12.5 basis point rate hike. Essentially, half a rate hike. The normal increments are 25 basis point. There are a few analysts out there calling for 12.5 basis points. I wouldn't be shocked, and this is my personal view, knowing the band is 0 to 0.25%, if they just moved it right to the upper end of that band. Hasn't really been talked about till very recently, but it wouldn't be a shock. Now, if this happens, I mean, we can talk about this tomorrow, that will be the harder trade because most people are preparing for this or this. Not many are preparing for something in between. And that's where it will be really important to focus on what Brannigan said. Don't get caught up early till you know what's going on, till you've read the statement. Because if this happens, that is something that, you know, it's really here nor there. It's kind of halfway house, and that will be hard to trade. And this is something you should plan for as well, because not a lot of people would have planned for it. But ultimately, very finely balanced on the rate decision. It could go either way. So after the rate decision, at the same time as the rate decision, we'll have the updated dots. And where you will see this is in the economic projections. So the median dots are expected to drop for all dates. 2015 expected to drop 0.25% from 0.625 to 0.375%. All the rest expected to drop around 0.5 percentage point. Now, I think for this time around, all we really need to focus on is the 2015 dots in conjunction with our rate hike at 7 o'clock, that is. So if the 2015 dots are unchanged, that is super, super hawkish. Why? Because there's only 3 meetings left this year, September, October, and December. If they are maintained at 0.625%, that's essentially 2 rate hikes from where we are now, from the 14 basis point level. So extremely hawkish. It probably means, if that's unchanged, that they've hiked rates, which you will find out about, but then the market will start pricing in another rate hike, because essentially a rate hike will get the market to about 0.39%. The dots, if they're unchanged, it will be at 0.65%. The market is, or analysts, economists, the market itself, traders are expecting the dots to be downgraded. So this is very much an outlier trade, outlier event, dots unchanged, because it will mean two rate hikes that the Fed is expecting this year. If the 2015 dots are lowered, this could potentially be quite interesting as well, because if it's lowered in conjunction with one rate hike, if that rate hike is a 25 basis point rate hike, it essentially means, well, that's one rate hike and we're done for the year. One rate hike will take the mid rate to about 39 basis points. If the dots move down as expected, it will be 37.5 basis points. That essentially means one and done. So that's sort of saying hike has come, guys, but nothing else, nothing is likely for the rest of the year, maybe next year. And that's probably when we will start looking at the tone in the statement. Yellen will be quizzed, etc., etc. But also equally important is if they're lowered in conjunction with no rate hike. It just kicks the can down the road a little bit. That is probably the most dovish scenario, looking at the Fed funds rates and the dots, because they haven't hiked rates, they've lowered the dots. What's to say that in the next meeting they still won't hike rates? They're just pushing things further down the road, and that's what they've been doing for the last year or so. Every meeting or every quarter, we've been seeing the economic projections being lowered and lowered and lowered, and the market pricing later and later lift off from the Fed. So really important that when you formulate your trade plans, you're looking at these scenarios, not just the rate hike, but what the forecast is for the end of the year, how it's changed, if it's changed, what will you do. Some of these won't be the easiest things to trade. This will be easy because it's a huge outlier. But the other two, it won't be as easy. That's why you need to formulate a plan. That's not to say you can't make money, but you just have to be a bit smarter about how you approach things. The dots further out, 16, 17, 18, 17 expected to be lowered. Recent Fed speeches have reinforced that they expect rate hikes to be gradual and slow, and not like in previous cycles where they've hiked at a measured pace, which has generally meant every single meeting. They won't do that this time around, and hence the 2016 onwards are expected to be lowered. And this time around we also get the first release of the 2018 dots. Hasn't been released before. Market won't really pay much attention to it. They'll be fixated on what's happening now up until the end of the year. But 2018 dots is due to be released as well, expected to be somewhere between 3 and 3.5%. But I don't think that should be too much of a focus of ours. Okay. Then after that, the economic outlook will be important to look at, and that could be found in this summary of economic projections, the statement, the press conference, the Q&A. At all those points, could they comment on that? So there's only modest changes expected in the inflation outlook, employment outlook, growth outlook from the Fed. But this is what's important, the inflation. We've said we expect employment to be, Fed to be happy with it. Growth outlook hasn't really changed. It's been for the last 9 months to a year inflation that has prevented the Fed from hiking rates. So inflation is, this is what it said in the last statement, inflation is anticipated to decline further in the near term, but the committee expects inflation to rise gradually towards 2% over the medium term. So as Brannigan went through the data, inflation has declined very gradually or remained around flat in the near term, but the Fed are concerned about medium term inflation. And essentially this could come up we could get the answer if the outlook has changed in the dot plot. It could be mentioned in the statement itself. It could be mentioned in the Q&A, in the press conference. So plenty of places that inflation could be referred to. Employment, as I said, Yellen should indicate even more confidence in the labour market. This employment hasn't been the problem. About 2 years ago, they said they'll be happy to hike rates when unemployment reached 6.5%. It's now 5.1%. When it reached 6.5%, that's when they changed their mandate to a dual employment and inflation mandate. So they shifted the goalposts, and that really got the market in a bit of a mess when that came about. But in the statement, labour market, this is what they said last time, labour market continued to improve with solid job gains and declining unemployment. So if you're looking at the statement, that's the area that we need to look at. Labour market indicators continuing to move towards levels the committee judges consistent with its dual mandate. We're pretty much there. Growth I'm not really going to talk about. It's been solid, expected to be upgraded slightly this time around with slightly lower growth in the future, but modest changes. Language and the forward guidance. Again, this could be in the statement, press conference, Q&A. Again, I reiterate how important this is, what they've been saying, because this should be the Fed's focus. Appropriate to raise the target range for the Fed funds when it has seen some further improvement in the labour market and is reasonably confident that inflation will move back to its 2% objective over time. So, the language, the forward guidance, will they talk about the lift-off? If this is only important, clearly, if they don't hike rates, because if they've hiked rates, they've lifted off. So we don't need to worry about any talk of Fed lift-off in the statement. If they don't hike rates, then this is what we need to look out for, really, what their forward guidance is. What will cause them to hike rates? What will be the trigger? What will be the catalyst? This is important if they don't hike rates. Irrespective if they hike rates or not, the pace, is it going to be measured, gradual, very gradual? They've emphasized in the past it will be slow and gradual, but any more guidance, what does slow and gradual mean? Is that once every 2 meetings, once every 4 meetings, once in a year? Who knows? That's something else to look out for. And that for spread traders, I know a few of you trade them, that will have implications on how the curve will move potentially. So that's something to pay attention to. Data dependency, they've said for a long time, they're data dependent, not calendar dependent. Now the data's been pretty solid, but irrespective of the decision, they can quite easily say, we're not hiking rates this time around, we want further improvement in the data, or so on and so forth. But this is not likely to go away, and this is why the pace will very much be linked with the data dependency. They've often said it's not about time, it's not about when we hike rates necessarily, it's not about right now, it's about the data warranting it. So we could have one rate hike today, we might not see another one for 6 months because they will be looking at the data. They're not going to be tied into we'll go every meeting or every other meeting. And another thing to look out for in the forward guidance is changes to the press conferences. Now, I didn't mention this at the start, but I usually do. They don't have a press conference at every single meeting. They have it at every other meeting, a Q&A, a press conference. There's been some talk that they might start having press conferences at every meeting. If they don't hike rates this time round and they say we're going to change their kind of scheduling and have press conferences every meeting, that will alert the market to maybe an October rate hike is coming. Why do they need to have a press conference in October if there's nothing new to report? So that's something we should be looking out for, especially more so, I think, if they don't hike rates this time around. That's what you should be alerted to. It's a sign that actually they're not hiking rates now, but October is very much a possibility. And then, again, this hints of a 2016 lift-off. Now, if they don't hike rates and the dots are lowered, which is a strong probability and possibility, the doves that are out there will be looking for, is there anything there that will actually suggest they're not going to hike rates this year? Maybe 2016 will be the first rate hike. Maybe it will be January. Maybe it will be next year. Then we look at how much of the dots shifted. Are there, is there a shift in the dot plot? How the composition of the dot plot has changed. When Brannigan showed it, they were very much clustered in around the median. Have any of the dots moved further along the curve? That's something to look out for. And finally, this is pretty important, I think, and this is something I discussed with John a little bit earlier today. If they hike rates, they're probably likely to balance it, a rate hike with a little bit of dovishness. we're hiking rates, but we're in no rush to hike further. We'll look for the data to warrant it. Or if they don't hike rates, they'll be like, we haven't hiked rates this time around. The data is solid, but we want a little bit more confirmation. So they could balance out a hike with a little bit of dovishness, or a no hike with a little bit of hawkishness. And again, that will be really important again to really analyze the statement, know what's gone on, don't get caught up in the headlights. I know 1 or 2 traders here have been told not, or given a curfew of trading in the first 10-15 minutes because it is too easy to get washed up. I know that's more some of the more junior traders, and it's more just because we are, risk managers are looking for you to learn from the experience and protect you a little bit, because even some of the senior traders here would never have seen a rate hike. I have, maybe 1 or 2 others on the floor have, but especially in this working office, I'd say about maybe 80-90% haven't. Yeah, it's probably myself and John Harmon and Dan, that's probably about it. So, finally, the global outlook. And now, to be honest, this is what, if they're not going to hike rates tomorrow, this is probably what's going to prevent them from doing it. Because everything I've listed here is not positive on the global outlook. This doesn't really matter, it's just more a statement. US economy is the exception as opposed to the norm. Easing's gone on pretty much every central bank around Australia, New Zealand, Canada, Scandinavia, ECB, QE. The Fed will be the first this year to hike rates amongst developed countries. Oil and commodity prices started to fall again, could feed into lower inflation, especially if the recent fall is demand driven. We've talked about supply numerous times, increased supply of oil, the shale market and so on and so forth, but is it still supply that's pushing the oil prices down, or is it weak demand? Weak demand could be as a result of China, weak demand from China, or its trade partners who are dependent on China demanding less. So they can be interlinked and into emerging markets as well. So China, low commodity prices, weak emerging markets could ultimately prevent the Fed from hiking rates. It shouldn't do, because they've said on numerous occasions low oil and commodity prices eventually will feed into stronger growth because people have more disposable income to spend. China, it's too early to measure its effect. In a month's time, it will probably still be too early to measure its effect, but it's still a risk that it does influence them. And emerging markets weaker, it's more, to be honest, I think it's more on the back of China that these have been weaker in the first place. And finally, the dollar strength has implications for growth and inflation. The strong dollar with weak global demand imports disinflation. But as Brannigan showed on the chart, the dollar is actually a little bit weaker marginally since the last meeting. But as I've stated here in bold, it really is the global outlook that's likely to be the key for the rate decision, because the data probably just about warrants that they should follow through with what they've been saying about their reasonable confidence in inflation and stable or gains in employment. Okay, as Brannigan, have you got anything else to add to your thoughts on what to look out for? No. So tomorrow we'll go through our trade plans. Me and Brannigan will pick 1 or 2 as per normal. We want you guys to come along with your trade plans as well. Today we've just given a fundamental overview. We haven't necessarily given our views to you. Brannigan's done a blog that you can read about his very rate hike view that you can see on FUTEC's live website. Really good blog about why they have to raise rates. We've tried not to impose our views on you in this workshop, because ultimately you shouldn't go into it with a bias. You can have your view, Brannigan will have his view, but he will trade what he sees, and that's what you need to do. Trade what you see, and and interpret it that way. You can have a view beforehand, but don't get caught in a bias. So tomorrow, market structures. Brandon, gonna, like he always does, go through a bit about the different markets. I'll go through a few trade ideas of my own. But again, it's open house. We want everyone to contribute. Come with your thoughts. But do the preparation first. It really is important. This, like I said, 7 years since we've seen a rate hike from the Fed. This is the first one. This could be your biggest day you've ever had if you prepare properly. It could also be the worst day you've ever had if you don't prepare. And there will be some who will just go into this blindly and just, haven't done the prep. They will trade price action when they shouldn't. They will just go, oh, okay, they've hiked rates and not look at the statement, or they haven't hiked rates and not look at the statement. There will be lazy traders out there who will pay for not doing their prep. Just make sure it's you that's taking the money off the guys that pay, because you don't want to be the ones that miss the 5-point down move in the T-note. You don't want to be the ones that miss out on the rate hike when it comes, because you'll all be prepared for this. This is what we do this job for, guys. Risk events like this. It is a big deal, potentially ground changing. First central bank to hike rates in a long, long time. And given it's the Fed, the most important central bank in the world, we should all pay attention. But trade plans tomorrow. All right, guys, thanks very much. Hope you enjoyed it. Hope you found it useful.
Sure, thank you.